Hi, this is Todd Baker, your certified mortgage planner, and in this video we're going to discuss different loan programs. So the first thing to understand is you need to be working with a trusted advisor that's asking you the right questions, that understands what your budget is, what your cash flow is, what the right amount of a monthly payment would be, what in terms of comfortable, what would be a stretch amount if you wanted to stretch a little bit. What's your short-term financial plan? Do you have an emergency reserve fund? Do you have a retirement plan set up? What kind of insurance do you have? All of those things have an actual impact. Then you go into what kind of credit score, what's going to be the best loan for your credit score, what kind of qualifying income, etc. So those are that's a backdrop of what you need to understand as a starting point. And quite frankly, most loan officers don't fit into that category. Most loan officers are like order takers, and they're just going to give you, take an application and then send back to you just a worksheet of what you're approved for with no explanation and no real kind of forethought, and you're not sure if you even got the right program. So the different programs are as follows. There's conventional loans. The conventional loan simply means a Fannie Mae or Freddie Mac loan. You may or may not have heard those terms before, but those are quasi-government entities. They're really what they're called government-sponsored entities. They're private companies that are backed up by the federal government, and they do home loans. The key features is a minimum down payment of 3%. They do have what's called private mortgage insurance for any loan with a loan to value greater than 80%, or in other words, if you put less than 20% down, there's some mortgage insurance. You can either pay it up front or most people pay it monthly, so that's one of the features. And on the conventional loans, debt ratios are restricted right now to 45%. You can go as high as 49%. So that means it can restrict your purchasing power, and they have their own set of guidelines. They're very sensitive to credit score, conventional loans. So the lower your credit score, the minimum score is 620, but when you fall below 680, there's adjustments that Fannie Mae and Freddie Mac make because of your credit score to the interest rate and also to the mortgage insurance premium. The companies that do the PMI, the private mortgage insurance, they adjust it as well to where if you fall below 680, depending on the loan, it might be better suited for you to go FHA. So there's three different government loan programs: FHA, which is Federal Housing Administration; VA, which is for veterans; and then USDA, which is the basically for rural or homes out in the country. For FHA, it's 3.5% minimum down. It has a fixed monthly mortgage insurance premium. It sticks with the life of the loan unless you put 5% down, in which case you get a slight discount on that, and it goes for 11 years. The advantage to FHA is it allows for a higher debt ratio. It allows a little bit looser credit. It's more forgiving on your credit. And it also allows for a credit score down to 580. So it hits a lower tier bucket to allow somebody that has, okay credits, a low score, but they can still qualify to buy a house. And then it also has better interest rates from that 620 to 680 tranche right there, much better interest rates. So FHA is a very, very popular loan program and an excellent loan program. If you're a veteran, VA financing is the way to go. If you qualify, if you have a certificate of eligibility, it's 100% financing. So all you have to do is cover a portion of the closing costs and you're out the door. Interest rates are very good. It's a very easy credit underwrite, so it's a great program. USDA is also a great program. So if you're out in the country, and there's certain definitions. There's actually a website. If you guys are interested, just let me know. I'll send you a link. You can look up to see if a property is in a USDA zone. But it also has income restrictions based on family size. There's also it's not as forgiving as an FHA loan. It's very restrictive on its debt ratios, and so that's another thing. So the advantages are 100% financing if you have income eligibility and if it's out in the country, but it also has restrictions on credit and debt ratio that sometimes are hard to overcome. The next is a jumbo loan program. That just means large loan amount. So a conventional loan, the Fannie Freddie Mac, right now, 484,350 is the maximum loan amount. If you need to borrow more than that, you have to go into either a first and second combination mortgage or what's called a jumbo loan. And that's for mortgages that exceed 484,350. And finally, there's specialty lending. And what I mean by that is that can be a construction loan, that could be a rehab loan. There's bank statement loans available now. Those kind of loans. There's down payment assistance programs available, which, by the way, as a community lender, I have all of those. So there also is specialty lending. The down payment assistant tends to couple up with conventional and FHA is primarily where you use those two programs. And they basically come in and pay for your down payment. So all you have to do is come up with the closing costs. So That's an overview. And the most important thing for you to understand is, once again, working with an advisor that looks at your tire situation, here's what you want, looks at your situation, and then makes and selects programs or the program that's going to best suit your needs. Thank you so much. I hope you find this helpful, and have a great day.